With the Dow Jones Industrial Average now over 14,000, a lot of investors are asking, what does that mean today? It's important to note as well that since the market bottom, the Dow is now up almost 120%. We really have to think about stock returns from a long-term perspective. If we start the measurement period from the market's high in '07, looking forward 5.5 years to today, the return has only really been about 3%. Now, if we look at that on an average basis, that means about 0.5% per year. If we adjust that for inflation then, which is running about 2%, we've actually seen a pretty long period of time where we've had negative real returns. Yes, the last 4 years have been pretty good with about 14% return, but if we look at 10 years, the returns have only been about 7%. Now, at Segal Rogerscasey, we believe that over the long haul, stocks should return somewhere between 7 and 8%. They'll be up markets and they'll be down markets, but over the long term, 7 to 8% is our expectation. Now, again, if we think about that mathematically, it means that stocks through time have to achieve new highs. Nothing exciting about that news. Not necessarily. There is no doubt that we have had sequestration on the expense side, and we've had some tax increases, and it doesn't appear to be the end of the world. That being said, investors appear to be more comfortable with risk assets, such as stock. It's also important to note that the returns for bonds are very, very low, and that's causing a number of investors to reconsider whether they should be owning bonds in their portfolios and can cause them to move assets into stocks. With a correlation of about 0.8, this means that developed markets outside the U.S. and the U.S. markets tend to move in the same direction through time. Not in perfect lockstep, but fairly consistently in tandem. On a forward-looking basis, we'd have to think that with increasing globalization, that those kind of correlations would continue in the future, and that as U.S. markets do well, markets outside the U.S., not necessarily perfectly, but will also do well. Well, certainly on one hand, there's the opportunity to participate in a growth equity market. The challenge is perhaps it's pretty late in the cycle, and perhaps if you're increasing your equity investments now, you're doing so with a good part of the bull market rally behind us. It's impossible to know at the end of the day really where we are in that cycle. Our expectation is over the long term, stocks will do fine. Stocks will earn you a decent return, and we think that's true in the shorter term as well. That being said, people have to understand that stocks go up and they go down. Sometimes, recall the last cycle, they go down violently. Investors have to be able to manage their way through the cycles that occur with stock investing. Well, first off, we should note that the Dow that we've been talking about is a pretty narrow set of stocks, only 30 stocks. So we would suggest to clients that when you're thinking about stock investing, think about a broader index than just the Dow. Think about the S&P 500, think about the Russell 3000, or even think about a global set of stocks with a global index. Diversification is an investor's friend, and that's an important consideration going forward. Second, we do believe that through time, when PEs get outside of their normal range or when earnings growth appears to be muted, that people should consider moving towards the lower level of their range of desired stock holdings. That being said, we think stocks are an important element of a diversified portfolio for the long term, but investors have to be prepared to manage through volatility because the unexpected often happens with the stock market.